This is a market graph from May 6, 2010. At exactly 1:41 p.m., the global financial system simply dropped. In the span of 5 minutes, $1 trillion in market value evaporated. The extremes hit instantly. Blue-chip shares belonging to massive, stable corporations traded for a single penny. Other stocks spiked to $100,000 a share. And then, less than 30 minutes later, prices rebounded as if nothing had happened. In the immediate aftermath, newsrooms and government agencies scrambled. Initial rumors blamed a coordinated terrorist attack or a total economic collapse. But the real culprits were much stranger. The crash was triggered in part by Navinder Singh Sarao, a lone day trader running custom software from his childhood bedroom in West London. His trading collided with a flawed algorithm used by a Midwestern mutual fund. We tend to think of the stock market as a rational fortress, overseen by human experts carefully weighing supply and demand. In reality, the floor traders are long gone. The market is a massive set of digital plumbing, driven by automated code, moving billions of dollars in fractions of a second. That plumbing is sustained by a single, fragile force called liquidity. And because humans are largely out of the loop, a single isolated actor, whether by accident or on purpose, can drain the pipes and bring the entire system to its knees. This is an order book. It visualizes liquidity, the ability to trade quickly at a fair price. A healthy market has narrow width between buyers and sellers, and heavy depth to absorb large trades. Today, that depth is provided by high-frequency trading algorithms, or HFTs. They continuously quote prices in milliseconds, pocketing fractions of a cent. Working from his bedroom, Navinder Sarao realized a critical vulnerability in this setup. These HFT algorithms are blind. They are highly predictable machines programmed to react instantly to mathematical signals. Sarao built a strategy called spoofing. He placed massive artificial sell orders just above the current market price, but programmed his system to cancel those orders the millisecond the price got close. The HFT algorithm saw this huge wall of sell orders and calculated a massive drop in demand. To protect themselves, they immediately retreated. Sarao weaponized the market maker's own programming against them, pushing prices down and profiting on the real trades he made in the margins. By the afternoon of May 6th, Sarao's spoofing algorithm was heavily active, flooding the market with phantom sell orders and artificially suppressing prices. Then, a secondary catalyst entered the mix. A mutual fund named Waddell Reed activated an automated execution program to sell $4.1 billion worth of futures contracts. But the mutual fund's algorithm had a fatal flaw. It was programmed to sell off the contracts at a rate tied to market volume, but the operators failed to set a price floor. The machine was instructed to continuously dump assets, no matter how low the price fell. The high-frequency trading algorithms were suddenly trapped. They were facing relentless, massive selling pressure from the mutual fund on one side and Sarao's artificial spoofing wall on the other. Confronted with math that defied their historical models, the HFT algorithms hit their hard-coded risk limits. Rather than take losses, they simply shut themselves down. In seconds, the liquidity providers completely withdrew, and market depth dropped to near zero. With the market makers gone, the few algorithms that remained active engaged in a hot potato effect. They rapidly traded the same contracts back and forth, looking for real buyers that no longer existed, sending prices into a literal freefall. The trillion-dollar flash crash did not happen because the global economy failed. It happened because the mechanical systems underpinning the market encountered an extreme mathematical scenario they couldn't calculate, so they retreated. Fast forward 11 years to 2021. The market demonstrated that this systemic fragility is not isolated to a single day trader or a rogue algorithm. During the GameStop phenomenon, retail investors organizing on the Reddit forum Wall Street Vets noticed that massive hedge funds had taken out huge, over-leveraged short positions, essentially betting billions that the video game retailer's stock would drop. The crowd realized they could force a short squeeze. By coordinating to buy up millions of shares at once, the retail investors artificially restricted the supply. As the price climbed, the hedge funds were forced to buy shares at exorbitant rates to cover their losing bets, rapidly draining their capital. The actor shifted from a solo algorithmic trader in London to a decentralized internet swarm, but the exploit was identical. The retail crowd successfully weaponized the blind mechanics and extreme leverage that Wall Street institutions had built for themselves. While the 2010 crash executed itself in minutes, the regulatory response took years. Government agencies lacked the real-time data tracking to understand what had happened, taking nearly 5 years just to parse the trade logs and locate Navinder Sarao. The primary solution implemented by regulators was the widespread adoption of circuit breakers. If a stock drops too fast, trading is automatically halted for 15 minutes. It is essentially a rudimentary off switch designed to pause the market when machines begin to panic. Sarao cooperated with the government and ultimately received a sentence of house arrest. A decade later, multi-billion-dollar hedge funds suffered catastrophic losses at the hands of a subreddit. The idea of the stock market as an untouchable, rationally governed institution has been permanently shattered. The digitization of finance successfully democratized trading, allowing anyone with an internet connection to participate. But it also democratized the ability to manipulate the plumbing that holds it all together. Today's market is driven entirely by code, immense leverage, and the unpredictable behavior of crowds. As long as those elements are in place, the next $1 trillion evaporation is always just one glitch away.